A lot of rental properties look profitable on paper, but once you add in the real cost, the numbers change very quickly. A new investor might look at a rental and say, well, the rent is $2,000, the mortgage is $1,500. That means I'm making $500 a month. But that's not real cash flow. This number is before vacancy, repairs, maintenance, management, taxes, insurance, any possible turnover, your capital expenses, and eventually there's going to be a cost to sell that property. So in this video, I want to break down why your rental may not be as profitable as the spreadsheet makes it look, and why some investors are starting to look at land as a cleaner alternative because of this. Now, to be clear as I'm starting this, I am not anti-rental. Rentals can build wealth. I use them myself. A lot of investors have done very well with rental properties. But rentals are not automatically profitable just because the rent is higher than the mortgage payment. See, the issue is that a lot of beginners analyze rentals and they just use incomplete numbers to do it. They focus on the income, they focus on the debt payment, but they don't fully account for the operating cost structure behind it. And that's where a lot of people get surprised. At the land method, we focus heavily on vacant land because the cost structure is very different. There are no tenants, there's no toilets, there's no roofs, there's no HVAC, there's no unit turnover. But before we compare rentals and land, let's again start with those rental numbers. The first mistake is calling rent minus your mortgage cash flow. So again, let's say that property rents for $2,000 a month and the mortgage payment is $1,500. Now that looks to be $500, but the property is not going to run at a zero expense for very many months. You still need to account for vacancy, you need to account for maintenance, you need to account for repairs, you need to account for the capital expenses behind it. There's going to be property management either by yourself or somebody else. Insurance may increase, taxes may increase. Eventually the tenant's going to move out. So the real question is not how much is left after my mortgage. The real question is how much is left after the actual cost of owning this property. And that number is always smaller. And in some cases, it actually can be negative. Now, this does not mean that the property is automatically bad. Maybe you are buying for future appreciation. Maybe the market is strong. Maybe you have a long-term strategy in place. But even with those things, you need to know the truth. If the property is not cash flowing, just call it what it is. Don't pretend that it's a cash flowing asset when really it's a break even or even a negative cash flow bet on future appreciation. Now, vacancy is one of the biggest costs new rental investors tend to underestimate. When the property sits vacant, the rent stops, but the expenses with it do not. The mortgage still needs to be paid. The taxes still exist. Insurance is still there. Utilities still exist. And then you have the cost of getting the property ready for the next tenant. There's going to be cleaning, paint, some repairs. You're going to change the locks. There's going to be marketing. There's going to be showings. You're going to have to screen these people. So maybe there's even some sort of concessions depending on what the market conditions are. So vacancy is not just a single missed rent payment. It's often a full turnover cycle. And if you have a tenant that leaves unexpectedly, or if the market is slower than expected, then that can eat months of projected profit that you have. So that's why a rental can look good at closing, but it can feel very different a year or even months later. The spreadsheet that you used may have assumed everything stayed occupied and everything stayed smooth, but reality doesn't go along with that. The next issue that you would come up with is repairs. A lot of people tend to underwrite repairs way too lightly. They think, well, this property looks great right now. And that may be true. But just like everything else, real estate ages, roofs age, HVAC systems age, water heaters fail, appliances break down, plumbing issues will happen, electrical issues will happen, flooring eventually wears out. Tenants just being in there create wear and tear. And even good tenants, no matter if they do everything right and take care of the property, they're still using that property. So that is where the distinction between repairs and capital expenses matter. A small repair might just be a few $100s, but they're going to exist. A major capital expense can wipe out years of cash flow. If you have to replace an entire roof, if you have to go in and redo a sewer line, if you have to put in a new HVAC system, if there's a major plumbing or major electrical work that needs to be done. So if a rental property is producing $150 or $200 per month in actual net cash flow, one major repair will erase a long period of profit from that. So that is where your reserves come into play and matter. A property may only look profitable because future costs are being ignored, but it doesn't really mean that they don't exist. Now, a lot of investors, they say, well, I'm just going to hire a property manager to deal with this. And honestly, that can be the right move. But property management, well effective, is not free. It does not remove all the responsibility from you. You have a monthly management fee for this. There may be a leasing fee, there may be renewal fees, there may be maintenance markups, inspection fees, administrative fees. If there's eviction, there may be coordination fees involved with this. Every one of these property management company structures it differently. So you need to understand the actual cost, not just some sort of light percentage that's going to be involved. Also, a property manager does not make the property risk that you have disappear. You still own that asset. You are still the one paying for the repairs. You are dealing with any underperformance that's there. You need to review the statements. You still need to approve any major capital expenses. You still need to hold that manager accountable. Not every manager is good. Things change. You may need to change that. So management can reduce your workload, but it's also going to reduce your return because of that. Now, if the deal only works because you assume no management costs and no value for your time, then you're fooling yourself. The next thing that investors often underestimate is how much taxes and insurance can change. Insurance has been a major issue across many markets lately. Property taxes can increase. Local rules can change. And when you eventually sell, the exit's going to have its own cost structure. You're going to have to deal with agent commissions. There's going to be closing costs. You may have to give possible repairs or credits. You may have to deal with capital gains or depreciation capture. Or if you're dealing with a 1031 exchange, then you're going to deal with that complexity if you're going down that route. This is why you can't just analyze the purchase. You need to think through the full life cycle of your deal, buying it, operating it, holding it, and then your exit. Now, again, rental properties can be good investments, but it's only that way when you understand the real net result, not just that monthly rent number that many people fixate on. Now, let's compare that to vacant land. Again, land is not risk-free. You do need to do due diligence when it comes to land. You need to understand access, utilities, zoning, flood zones, wetlands, looking at the title, the taxes, the buyer demand, the pricing, the usability. I just did one today where I spent a lot of time going back and forth looking at some water issues and seeing what they were. But when you do all of those things, the cost structure is different, right? There's no tenants. There's no evictions. There's no broken toilets or anything like that. There's no water heaters to go fix or replace. There's no HVAC units. There's no carpet or flooring there that needs to be replaced between tenants. There's no roofs. There's no worrying about unit turnover. There's definitely no traditional property management layer. So that all of that is why land can be attractive for investors who want to have that real estate investing exposure without all those operational headaches that come with rentals that we talked about earlier. Now, you can buy land at a discount. You can then resell it for cash. You can sell it with owner financing. You can create monthly payments with that without the tenant. Sometimes you can split the properties, meaning subdivisions, or improve it. You can reposition the property. And saying all of that, it's not to say that these things are effortless, but it is a different kind of work. You're focused more on acquisition, due diligence, your pricing, your exit strategy, instead of this ongoing tenant and building management that comes with a rental property. So, is your rental profitable? Maybe, right? But the numbers have to include reality. It's not just rent minus your mortgage. You need to account for vacancy, for turnover, for repairs, for the capital expenses, the management, the taxes, the insurance, the time, and the exit costs. We already talked about all of these things. And if the deal still works out after you build all of that in, then great. But if it only works when you ignore those hard costs, the numbers are telling you a different story. And the truth is, the numbers don't lie. That is why so many people are looking at alternatives right now. The market simply is not the same as it was a few years ago. Rentals are definitely harder to cash flow in a lot of areas. Flips are harder because of higher costs and tighter spreads. Land investors who are using old assumptions, they're struggling too. So I just wanted to say that's why we're putting together a 5-week land investing training focused on what's actually working in the current market. Current marketing, deal evaluation, a seller conversations, finding values that are out there that other people miss, like the property I was just talking about that I was looking at today, and then selling in today's market. This is going to be live, direct. It's going to be built around real questions, not just a passive course. So for investors who want more direct help, the link to schedule a call is in the description, right? We can talk you through what exactly we're doing, see where you are, and see whether this is a fit for you or not. Also, for everyone, we created a free due diligence playbook to help you evaluate land deals before you buy them. It covers the things we talked about: access, utilities, zoning, flood zones, wetlands, title concerns, pricing, buyer demand, overall usability of those properties. So grab a copy for yourself. Again, it's free. The link is in the description. And one thing I'd like to hear from you, post in the comments. Let me know. If you've looked at rentals before, what surprised you the most about it? Was it the vacancy? Was it the repairs? Was it the management? Was it the taxes? Was it the time involved? Or was it something completely different? Drop it below and let me know.